Hey, good morning, guys. Welcome to Market Tuesday. Sorry, I just got back from Spain and from last week, so I apologize for not doing videos last week, but I was really enjoying myself. But we're getting right into it. We're going to be talking today about what's going on with the Fed cuts and how it actually impacts mortgage rates. And in addition, we're going to give you a dad joke before we get right into it. So, dad joke today is, I would tell you guys more jokes about unemployed dogs, but none of them work. Pew, pew. All right, so getting right into it. Last week, we had a really crazy, well, not crazy, but expected report of what the Fed was going to do with Fed rates. Okay. And we were all basically looking at the September timeline of 17th, the September 17th and 18th in regards to what the Fed was doing in regards to the Fed funds rate and with whether if they're going to cut the Fed rate or if they're and by how much. And we were kind of looking forward to this since basically June in regards to what they're going to do and how everything was going to play out from all the unemployment rates and as well as the inflation reports. Luckily, everything kind of trended the way we wanted it to go and showing basically job market is cooling off. Unemployment rates going up. We have inflation going down and all these other factors showing that the economy is finally getting to a more of a stabilized period. Now, luckily, the Fed met last week and decided that they're going to cut the Fed rate by 50 basis points. What that really means is that they cut the Fed rate down to 0.5%. So instead of the 5.5, 5.25, now it's around 5.0, 4.75. Now, the reason why they did this because the Fed rate is a tool that's used by the Fed to control the growth of the economy, right? If it's going too fast, things get unaffordable. The distinction of affordability gets crazier and crazier. So if they don't control how fast the economy is going up, they need to be able to slow it down. And that's what they essentially are doing with the Fed rate. Now that the economy is slowing down, they don't want it to slow down too much. So they're tapering off. Now, a lot of people have the mistake of that if the Fed cuts the rate by this much, it cuts mortgage rates by this much. I'm sorry to inform you, but that is not how it works, unfortunately. The Fed rate does not directly impact how mortgage rates go. And there have been some historical times in the past where when the Fed cut the rates, mortgage rates went up, actually. Depending on what's going on with the economy, because it's a multi-layered, multifaceted situation when it comes to the economy. So, but the answer to your question on if it actually improved mortgage rates is the answer is no. It didn't actually improve mortgage rates for this specific circumstance. If anything, it pretty much stayed roughly the same. Okay, really not much change in the Fed rate at all on the day when they cut those Fed rates. For the most part, rates are roughly about the same. For most of last weekend, even today. So there's really not much change in mortgage rates at all, even since the Fed cut the rates by 0.5%. So, but I do want to say that the Fed rate does influence what mortgage rates might do depending on the economic picture. Okay, so you can't just say, "Oh, Fed rate goes down, mortgage rates will eventually go down or go up." There's more to it than that. It has to do with the current position of the economy, whether it's cooling down or heating up, vice versa. There's so many things. So you can't just simply have a conditional statement. This goes down, therefore this goes up. It's really not that simple. So, but for the most part, it is a good sign to show that the Fed is paying attention to the economy. So this is what they need to do. This is what they're expected to do. And it's really not bad or good. It's really what's required to maintain a good and healthy economy. So I don't think that the Fed raising rates or the Fed cutting rates is a good or bad thing. It's more, is it required to keep the economy at a steady level? And that's what they're really trying to do. So that's what's really interesting. It's at the next point is trying to figure out what they need to keep continuing to lowering the Fed rate at the next meeting. We don't know what's going on as far as the next Fed meeting goes, but I think if everything continues to respond favorably, they may continue to lower the Fed rate moving down. So the other thing that we want to kind of talk about is the biggest driver in how mortgage rates are behaving is the health of the labor market. So to give you guys some feedback is that the unemployment rate's at like 4.2% right now. Not a hard 4.2. It's a little bit higher than 4.2, but it's effectively 4.2. Now, that's the unemployment rate has steadily gone up over this last year. Now, the important thing now is how has it been for people to get jobs or lose jobs? Right now, in our current case, is that there has been an additional 219,000 people who have filed for unemployment for the first time, which is a lot of people. So more and more people are having a hard time finding jobs, and more people are getting laid off. That's what's unfortunate. So our labor market is continuing to cool off, which will improve rates as these reports come out showing that rates are getting better. Now, looking forward to this week, there's going to be 2 days this week that are going to have a really big impact on rates that we know of. One is Thursday. We're going to see that one of the jobless claim, latest jobless claims and initial jobless claims that's coming out Thursday in regards to people filing for unemployment benefits and things like that. And then on Friday, we get another inflation report that comes out that the Fed has they're more looking at than the other two inflation reports. So this Thursday and Friday are going to have a big driver in how mortgage rates behave. So we're going to be looking forward to seeing how that goes. I'm hoping we continue to see really good progression in how mortgage rates have been behaving. Just to give you an idea, we've been seeing a very obvious downward trend, which has been really super great. Rates are really nice and getting lower and lower. So we might see the intended 5.5 that we had been talking about at the beginning of the year. And if that works out, that's pretty awesome. If not, we may see it next year. So it's slow. I think at some point the progression is going to be even slower because it's been a pretty substantial drop just in the last 3 months. So I think it's going to slowly taper off and not change as much over the next couple months. So we'll see how that goes, but we'll see. So, but overall, I think we're still in a pretty good spot. I think still a great opportunity to refinance for those who have, since we're in September, anyone that bought a house in February of this year or earlier and are at a rate of, I would say 6.5 or higher, are in a good position to potentially look to refinance. We're saving clients a buttload of money right now, which is pretty cool. So I think February is sooner and have a rate of at least 6.5% or more. Really good time to think about refinancing. Once we get into October, it'll be March of this year or earlier. So anyway, that's all I got for you guys. Hopefully you guys have a great week, and I'll touch you guys soon. Nuke out.